Break it down what today looks like versus the last couple of trading days.
Well, we're seeing a bit of a relief rally here and very strong volumes in corners of the market where I think people have been looking for buying opportunities. If you look at areas like artificial intelligence, look at areas like small caps, a lot of investors have been hunting for deals in these areas. And now that they're off, 10, 15, 20%, it represents a really attractive entry point for long-term investors. So we're seeing people get very granular about finding targeted opportunities for these lower valuations here.
And they therefore think that the valuation erosion that we've seen in some of these AI names, some of the chip stocks in particular, that they're at the right buying price right now, Jay?
Well, there's certainly at contracted valuations here. And what we've been hearing from clients for a while is, they love the AI story. They see the structural disruption. They see the massive total addressable market of artificial intelligence. It was really just a question of valuations. Was this an area that was a little too hyped, a little too inflated by the markets? Now that you're seeing those prices basically 20% off since the beginning of the year, those concerns are gone. And yes, maybe the landscape looks a little bit different, but if you still zoom out and look 10 years ahead, there's a ton of conviction in artificial intelligence. And at these valuations, it's hard to pass over.
Jay, if the trade conflict goes on indefinitely, is there a corner, a specific area of the technology industry where you do want to boost your exposure?
There is. We actually brought out a strategy a couple of years ago very focused on this, which is IETCs, our U.S. tech-focused ETF, and it's specifically looking to remove geopolitics from technology stocks. The tech sector has over 60% of its revenue coming from overseas, very globally integrated supply chains, and if you can really isolate companies that hire, build, and sell in the United States, you can still get that tech exposure, that tech growth, but try to limit
well, what's in it?
And limit some of the impact of supply chains.
Jay, what's in it? What names are we talking about? What specific technologies, specific supply chains do you want to go into?
Well, if you look at the portfolio today, it's actually underweighting several of the Mag7 stocks that make up such a top-heavy amount of the tech sector as well as the communication sector. A lot of those stocks are still very globally integrated, have a lot of sales overseas. It's looking more domestically, sometimes at e-commerce companies that do a lot of buying and selling within the United States, some AI-related companies that are doing a lot of buying and selling in the United States. But it's really kind of reweighting the tech sector, and that top 10 looks very different in a fund like IETC than just kind of the broad tech sector.
Jay, how are you currently discussing with those that are allocating towards your funds the long-term versus short-term? How many are wanting to commit at this moment if they are worried about what the next headline seems to be bringing?
It's really about getting granular and taking that long-term view. We have seen a lot of investors, again, are really kind of looking for what's the targeted exposure that they have the highest conviction in over the next 5 to 10 years. And look, you get compensated for taking equity risk, and we're seeing equity risk play out in the markets today. So if you can take that long-term view, get granular on the themes like artificial intelligence that people believe in over the long term, we believe they should be rewarded over time. So, in many ways, it's opportunity hunting, but it's also, behavior and behavioral coaching around being invested and staying invested during turbulent times.
It's important to remind oneself that all of the things we've been spending the last 2 years talking about haven't ended or gone away. The AI infrastructure build out, all of the forecasts are multi-year. I guess for you, when you think about construction and you think about clients, it's your conviction on whether the trajectory we were on in 2024, particularly around AI infrastructure, data center, continues. Do you feel that way?
I don't think there's a major shift here. Tech companies are very good at planning for the long term around these very, very, capital intensive build outs. And so if you're building a data center today, it's because you believe in AI 3 to 5 years from now. And I think what's different about this time around is you have tech companies that are flush with cash, that continue to bring in new cash through free cash flow, and they see a huge potential market in artificial intelligence. So they're excited to invest in this space. They're excited to put their capital work, and they're planning for the future.
You said the word cash 3 times there. Interesting. Data center, memory chips. You guys interested in that market?
We are. So we look at the entire AI technology stack for opportunities. And, you could kind of look at the bottom of that tech stack, starting with what is the real estate that is really hosting the digital infrastructure required for artificial intelligence. On top of that are a lot of the semiconductor companies, not just GPUs, but memory, transceivers. we really like that digital infrastructure area right now because that's where a lot of revenue is being channeled in artificial intelligence for the next couple of years as we see a build out of AI.